Good afternoon, everyone. We're just letting everyone in through the waiting room. So thank you for being on time and sitting there waiting. Yeah, appreciate you joining us again this afternoon. Just giving it a moment for everyone to come in, and then we will get cracking. All right. Well, as standard, fairly standard line for me. We like to reward those who are on time, so we'll get started with the day. With the session. So thank you very much for joining us for the afternoon session of our webinar this month. Given that last month we had the ATO mate and Hank along, so we've this time you're back to just having a listen to myself. So please feel free to jump in if you have any questions. Either put it in the chat or just unmute yourself and speak over the top of me. I'm more than happy to be interrupted to work through anything if it pops up in your mind as we work through it. So today, I really wanted to just have a relatively quick sort of chat. Well, when I say relatively quick, it won't be quite as long as some of them, but I wanted to have a talk through, I guess, the importance of having a bit of a change in mindset around where insolvency fits in the market when we're dealing with people in the turnaround space. So when they are in distress and they need some options, and really trying not to consider insolvency as the last resort. It is a tool that can be used more effectively if we think of it as something that we can use to help get people through. Now, before I jump into that, I will jump into a few of the stats that are going around at the moment. Some of the stats are starting to come out now, a couple of weeks beyond the end of September. So we have those quarters results. Excuse me. And certainly one of the big points to note is that insolvencies are rising again. They went through a little bit of a lull in July and August, but September numbers brought them right back up again. And there's been another 13% increase in insolvencies in the last quarter. So quarter on quarter, we're still seeing quite some growth in that area. And it's probably not surprising when most of you who were dealing with your clients would know that there's certainly no shortage of people struggling to make ends meet from a business point of view. Certainly margins are much tighter. Profitability is out the door in a lot of cases, or they have got some profitability, but the legacy issues that they're dealing with is eating up all their spare cash. So I anticipate that will continue to grow leading into Christmas. There'll probably be a lull again in January because there's very little pressure that comes in January, and then it will build again into next year. So unfortunately, I think we're a long way from seeing the end of it, and I don't think it's any longer something to consider that it's just the layover of COVID anymore. I think it's really what we're seeing now are businesses that have tried to survive through COVID have spent the last 18 months or 2 years trying to recover from it. But the market conditions have changed so considerably that we're now not seeing that growth. We're not seeing the profitability to deal with that growth anymore. So that's why I think we're struggling through that. One of the big movers in the last quarter, we often talk about construction and hospitality being two of the biggest insolvency industries industries that are dealing with insolvency at the moment. But the big mover at the moment is actually transport and warehousing. So we're seeing there's a real growth in that area. Certainly, the cost structures for those type of businesses there's very fine margins, and the cost of doing business is certainly increasing in those areas. So we're seeing a lot more of the transport industry, particularly long haulage, is in all sorts of strife. and we're seeing a big increase in insolvency in those areas. The other big interesting news that's come out of the last quarter is how far the SBRs have dropped off the perch in terms of their popularity. If we go back 6 months, if we look at sort of March of this year, there were 343 SBRs that were done in the month of March. In the month of September, even though it's a rising insolvency month, there are only 180 done. And that leads a lot from the conversations that we had a couple of months ago, and for those who are at our seminar, in regard to the changing attitude of the ATO when it comes to SBRs. So if we go back 6, 9, 12 months ago, if you put an SBR up, the ATO were just accepting anything, regardless of loan accounts, the past history of the business, the profitability of the business. They were just approving everything. It was one of the easiest ways to get a reduction in your tax debt. Now, probably in the last 3 months particularly, or 4 months, there's been a massive change in the ATO's attitude to SBRs. They are scrutinising everyone in a lot more detail, and they've certainly put in a number of rules in their mind around what they're willing to approve and they won't approve. And I'll go through that with you a little bit more in a minute. But because of that change in attitude, there's certainly not as many being put up now because they're just not going to be accepted. Couple of other interesting stats that have come out of the last few days. Payment default rates in small business have increased by about 5.5%. So we're now seeing more businesses are struggling to get paid, which means that they're struggling to pay their people. So we have this sort of merry-go-round effect of payment defaults starting to increase. And unfortunately, the more that increases, the more it's likely to increase. So we're seeing that's certainly a number that's in growth phase at the moment. There was another stat recent that came out this week that showed that small business risk is up nearly 15%. So in terms of small businesses with a likelihood of insolvency, that's now risen 15% in the last quarter. So there's a real that continual pressure that we're seeing on the small business in the market in terms of the pressure for them to try and survive. So there some fairly big increases in numbers. The other big one that again dropped off the perch a couple of months ago were ATO default reporting. For those who don't remember, ATO default reporting occurs if you've got a company that has a debt of more than 100,000. They now have the ability to report that default on the company's credit report. That nosedived a little bit for a while, but again, it's back on the increase. So there was, and a lot of it, according to the analysis, is actually coming from new tax debt. So it's not just old debt that they went into a payment plan and then dropped off. This is for new debt. We're seeing an increase in credit reporting for those businesses again. So those numbers are right back up. What's really interesting about that number for us as advisors is to really keep in mind that the stats show that if a company has a tax debt of over the 100,000 and they're reported, their likelihood of insolvency rises pretty much to 26% within 12 months. So if you've got a client who receives even a warning letter saying that they're going to that they're likely to report them as a credit default, then their likelihood of insolvency rises to about 26%. So there's some fairly significant pressure that we're seeing all over the market when it comes to small businesses. And again, I don't think that's any surprise for anyone listening today. If you excuse me, if you look at even any client that you're talking to, most of them are finding that their profit margins are tighter. sales are dropping a little bit. There are some that are doing the opposite to that. There's no doubt about it. But overall, I think all businesses are certainly finding things a little bit tougher. The cost of doing business, as I've spoken about before, is still rising. The pressures on wages are rising because of the cost of living expenses. So all of those things continue to put pressure on business. And when you don't have that spare profit margin, the flow-on effect that really impacts is their ability to deal with anything that's in the legacy area. So if they're holding old tax debt, hoping to become more profitable so that they can pay that tax debt off, or try and maintain payment arrangements that are set up in the hope of more profitability, those things are putting more and more pressure on businesses all over the place. So there's no doubt that those things are rising everywhere we look. So what I wanted to talk through today, for those of you who actually came to the seminar, our in-person seminars that we had over the last 2 months, some of you will know some of the things that we've talked about, but it'll be a good refresher. And for most of you, because I know some of you just prefer the online stuff, we'll talk through that. So we talk about I like to talk about insolvency as a tool to help a business turn around. When you think about normal turnaround stuff and things like looking at how we can increase profit margins, how can we increase our sales, how can we reduce our expenses, how can we do all of these different things to help the business become more profitable? I want to be clear that that's not the area that Jonge focuses on, and it's not what I'm going to go into the detail talking about today. There are other specialists out there that are much better at that sort of thing than us as a firm are. I know in my previous life when I had my accounting practice, I really did enjoy doing that type of work, but it's not something that we deal with in any detail here at Jonge. So what I'm talking about is that while you're doing that work to make sure that your client's business is profitable, that it is making the money it needs to be, validly in business. Sometimes when you've got some significant legacy debt, or you've got ATO debt that's compounded over the years, you're now back in top and making profit, but you can't deal with that old debt. Using insolvency as a tool to allow you to move forward, or allow that client to move forward, is what I really want to talk about. I really want to try and get all of you to understand it's not the last resort. Here in Australia, we still have a bit of an attitude that insolvency needs to be the end of the line. But that's not true in any sense of the word, and it's not actually necessarily designed to do that. So in some cases it is, and it is a way of finalising the affairs of a business, but it doesn't have to be used in that way. And if I give you a really simple example at the top, from a top end of town type business, nearly all of you would know about 5 years ago that Virgin Airlines went into insolvency, went through a voluntary administration and deed of company arrangement. In really simple terms, and any business of that size has got its level of complexity, but in very simple terms, they had $6.9 billion in creditors in the Virgin business when it went into voluntary administration. When they came out via the deed of company arrangement in just on 10 weeks, they came out with 3.4 billion in creditors. They were able to reduce their creditor balance by nearly 50%, which then allowed them, in that restructure of their balance sheet and of their debt structure, it gave the business the opportunity to move forward. And luckily for Australia, at least, we've still got a 2-airline system with a couple of smaller ones trying to get through. Now, we'll get more of the detail on the numbers in Rex as that comes out, but that's another airline that's now making use of the insolvency frameworks and voluntary administration, particularly to restructure their debt path to give them a chance to move forward. So what I really, the focus of today is very much around that the big end of town can use those tools, and they've got, and I know some of the advisor costs that they had were, exorbitant, but for a business that size, they need what they have. But their advisors are no different to what we at Jonge are here to do for your small businesses. We just don't have the ability to, or the need to charge anywhere near to those levels. But a small business should still have the right and the benefits of using these tools to allow them to have a second chance. And it's important, knowing that we've got these businesses with over 100,000 worth of tax debt and with such a high failure rate, that the ability to actually do something about it is key. Now, if I bring it back to a small business scenario to try and help understand what we're talking about, if you've got a client, we had a client with just on $100,000 worth of tax debt. They'd been able to do the turnaround part of their work, and they were now making a profit. And with the work that had been done with their accountant, they were comfortable that they're now in a position that the business was going to be making about $100,000 a year. Now, we all know that if you're making 100,000, sorry, it was about 170 in tax debt. We all know that if you're making 100,000, the business owner sits there and goes, "Oh, well, I'll be able to pay the tax off in 2 years." Now, we all know that that's not quite how it works. And when you take in the income tax on the profits, and when you deal with all of the other components, to be able to deal with paying off an old tax debt out of profit, which is where it's got to come from, you're going to take another 3 years. So if you can get a payment plan to last 3 years, you got 3 years of work making $100,000 profit, and all of it's going to go to the tax debt, and there'll be nothing for the business owner for that 3 years. So what we're talking about is that if you can do a virgin-like model and you can reduce that debt by 50%, all of a sudden it's a bit of a game changer for a small business to be able to have a chance to walk out the other side and know that there's some profit there for the business owner for all their hard work, and you've got control over how you're going to survive through that. And that's really what we want to talk about, what I'm trying to get across today. Now, I want to go back to talking about SBRs for a minute. Most of you who have listened to me in the past would know that I do like the SBR, but I think it's a system that's being abused at the moment. And unfortunately, it's been marketed very badly for a lot of our clients who would be listening. So to give you an example of what I mean, well, your clients won't be listening today, but if they're in, I'll give you an example. I've got a client, sorry, I'm probably not calling it a client yet. It's probably a prospective client. They rang me up just last week. They have a tax debt about $130,000. The accountant had actually emailed me about a month ago and said, "Look, I'm going to tell this client to give you a call." Didn't give me their number, just said, "Yeah, you might get a call from this person." Didn't hear from them, which is not unusual, and I'll come back to that in itself. But what they did do is that they realized that they were getting scared with the tax debt, so they went to the Google machine. So the Google machine told them that they should look at an SBR. So they rang, and if you Google SBR, you get all these chatbots popping up going, "Yeah, talk to me today." So this client had actually done that, got on the phone to one of them, and they quoted saying, "Yeah, we can solve all your problems. We'll just do an SBR. You'll get 25 cents in the dollar, and everything will be great." Luckily, that client went back to the accountant. The accountant said, "Look, give the Jonge a call. They've got an independent view on it all, and make sure that they believe that that's the right way to go." Now, for this client, potentially it is the right thing to do, but when we asked a few more questions like, "Do you have any outstanding super?" The answer was, "Yes, we do." The problem is that you cannot get an SBR approved if you have outstanding super. So this client had been led down the path. They'd quoted him a fee on what they were going to do it. And you can lodge an SBR with outstanding super. There's nothing illegal about that. But you can't make an offer to your creditors with outstanding super in play. So again, I might have a client who's got a DPN expiring. I can put them into an SBR today, knowing that I've still got 2 weeks to pay any outstanding super before I make the offer to the creditors. But when I spoke to this client about that, no one spoke about that with him. And what I know will happen if he went ahead with it is that in 2 weeks' time, they'll go, well, you need to pay the super, so you can't pay it. Oh, well, it falls over. And by then, they've already paid the $18,000, or in this case, it was $16,000 to do the SBR, but the SBR falls over. So the problem that we're finding when we're trying to talk to your clients is the Google machine has done its thing. It's given them some information, but the reality is that there are a lot more factors involved in determining what is the best path of insolvency for a client than just going SBR. Now, by the drop in numbers, that message is finally starting to get through, because they also know that you can't just make a payment, make an offer of 20 cents on the dollar and get away with it anymore. One of the other big issues, and the reason why I'm telling you this, is that of the 3 clients that have come to me in the last fortnight who had gone and got advice and in some cases quotes for SBRs, all 3 of them then went back to their accountant, and then the accountant sent them to us. The reason why I'm telling you this is that you are going to get these inquiries, and it's really important for you to understand that it's not just as simple as saying yes to it anymore. So one of the other big issues that the ATO are now clamping down on is if there are any outstanding director loan accounts where the directors are owe the company money because they've taken it rather than wages, or they've just taken some extra money out to help cover the cost of living at the personal level. The ATO is now saying that we want that loan paid back in full, and then you make an offer. So if you've got a debt of 150 and you've got a loan account of 100, you're basically going to need to offer nearly 100 cents in the dollar if you want to get through. And you need to pay that 100 almost up front. So again, if you can't, the SBRs are falling over. Now, both the good and the bad thing about the SBR falling over, the good thing is that the director just continues to run the business. You may have dealt with the DPN issue, if that was the pressure that pushed them over the line, because the DPN is deemed to have been satisfied for the purposes of it being one of the methods. It doesn't get rid of the debt, but it satisfies the personal liability issue. But we've still got all of these issues still existing because the DPN's now, the SBR's fallen over, and the director's another 15 to 20 grand out of pocket, and they haven't had any resolution to their debt problem at all. In some cases, what we're finding is that it was never, ever likely to succeed. But it's sold on well, let's see if we can get away with it. I would rather, and Jonge would rather, that we tell you and tell your clients the facts about what's likely to work and what's not likely to work. So therefore, sometimes we're not going to recommend an SBR because we don't think it'll work. We've got a client at the moment where they've gone and done all of their own research. They got a quote for 18,000. We had a look at it. We don't believe it's got any chance of getting up, but they came back to us when there was only 2 days left on their DPN. They were relatively sold by the practitioner that it might work, and we said, we'll go with it, give it a go. At worst, what the $18,000 will do, we'll just make sure that you don't need to pay the DPN, or the DPN won't become personal. When it falls over, come back to us and then we'll do what we would have done otherwise, which is do a full restructure of the business. They're the things that we're now needing to deal with And I'm hoping by talking to you all about it, we can actually get to a point where we're not actually we're trying to get back control of some of these clients so that we can actually give them the right advice and give them the right path forward, rather than being stuck in the situation where they're now second guessing the advice that they're getting from all over the place. So they're just things that I wanted to raise and highlight. Certainly the director's loan has now become a real issue. I know. Well, I've been told in the last few days that a number of accountants are telling me that when they're trying to put payment plans in place, the ATO are actually telling them to go and do an SBR. One of those clients we're working on at the moment, which actually came from probably about 2 months ago, the ATO said, you should go and do an SBR because I can't approve a payment plan. So the client came to us. We did an SBR on the ATO's recommendation, and it was probably the best thing for this client in the first instance. We went through the SBR process. The ATO is now, with the extra information that they get from the small business practitioner, are now saying to this same client, we don't think you're profitable enough, so therefore we're not going to approve the SBR. So this poor client's gone through the whole SBR process, made the offer as per some of the discussions that they'd had with the ATO. We've done a whole lot of work to try and make sure that it's set up the right way. And now they're coming back going, well, we don't think you're profitable. We're worried about the age of the director. Even though the payment plan was only for 2 years that we were looking, they're still worried about the age of the director, and they're unlikely now to approve it, which now then means that we have to move into a new form of insolvency because the debt doesn't go anywhere. So now we've got to look at doing a restructure for the business, and restructure it through when the small business restructure fails. Now, in this case, it was always the contingency plan that we had for our client, so they were aware that it was, if we got lucky, we got it through. If we didn't, then this is where we'd end up. So you as advisors are going to be talking to more clients who are doing the Google machine searches and then coming to you going, hey, I want to do one of these. The more information I can give you about how difficult they are to get over will hopefully give you some strength to be able to go, well, let's look at this properly. Now, I want to take it to another level and just talk about where, with the level of debt that's out there for clients, and a lot of clients who are holding on to a lot of this old debt. One of the other things that we're seeing is that people are borrowing money to try and pay down the debt, and then they're coming back to us in 12 months' time and going, well, I borrowed all this money last year, I paid it down, but I'm no better off. I used the example in our seminar of a client that we did have that had an investor that was coming in that was willing to offer $1.5 million. Their tax debt was approximately 1.5, and with interest and charges, if you could take that off, it would have been about 1.1, 1.2. Now, whether it's an investor bringing money in or whether it's borrowed money coming in, the story is very similar. In this particular case, we said when we first sat down with them was, well, you can do that, but what if you looked at trying to do a VA and DOCA? If you did the VA and DOCA, we would be able to reduce the debt of the net debt of the business. In this case, we were able to reduce it down on 22 cents in the dollar. So of the 1.5 million that we used, the 1.5 million that the investor had available, we used about 780 of it to pay the tax debt out via a DOCA. Now, there are other creditors involved in that as well, so not all of it went to the ATO, but 780 of the 1.5 million was used to deal with the legacy. We then had the rest of that 1.5 million was available to the business to help it with its working capital to move forward. And what I want to really get across is if we use insolvency as advisors the right way, we can really help a business come out the other side strong. And then therefore they're going to be able to get through what I still believe is going to be another tough 12 to 18 months. And then they're going to come through with strength onto the other side of that and give them a real ability to actually have a chance to survive, make some real profit, and actually be a business that's actually going to give them growth and wealth into the future. If we sit here as advisors and spend the next couple of years trying to find ways of helping them limp through, there's such a high probability that it'll end up going bad somewhere in that period of time. If we can start changing our mental thought and start thinking that, hey, can I do a virgin for this little client, for these small business clients, you will then be able to give them the real strength to move forward. The earlier we can do that, the greater the ability is that we can have a greater result. If we're still doing it when a DPN arrives, if we're doing it when a creditor stat demand arrives, because the client has put their head in the sand, we can still do a lot to support them. But you, over the next couple of months, the next 12 months, where you're going to see a lot of clients in this position, and I can really tell you that there is a lot that can be done that's much better than just going, well, we'll try and borrow some money, we'll just try and get another payment plan. Use this as an opportunity to restructure the business and give them a real fresh start with some strong legs for the future. Now, so I hope I haven't come across too strong. I think it's really important that people are hearing this message because unfortunately the Google machine is telling all sorts of other things. The other thing I wanted to just spend a couple of minutes on is talking about, and I can't believe we're already talking about Christmas. It feels like we only just got over Easter, but we are a couple of months out from Christmas. Unfortunately, nearly every year since I've been in this business, which is nearly 15 years now, we've ended up with a company or two that we've had to help put into liquidation the week before Christmas because they can't manage or afford the costs that are coming up. We have, as we all know, there are a lot of businesses that January is a real shutdown period. They generally stand down all their staff, they pay out all their holiday pay all their wages, and then they go on their way for 3 or 4 weeks, coming back in January and refire up. Given that we've had such a tough year financially, there are a lot of businesses that are going to be very much closer to the edge coming into this Christmas period. They're not going to have the fat in the bank account to be able to pay everything out. If you have clients that have this major shutdown and they have a major cash drain in December or a major cash drain in January, can I highly recommend that you talk to them now about whether they're going to have the way to get through? Because if we can plan the shutdown better or plan the process better, we're not going to end up with what I have most years, and that is having to help a director tell a whole bunch of staff that they're not going to get their Christmas pay because they need to go into liquidation the week before Christmas. It's not a fun experience for the director, and it's not a fun experience for all the staff, and some of it can be dealt with earlier if we know in advance. So I think given the way that this year's gone and how lean everyone's bank accounts are, I think it's really important that if you've got clients that you know have a major shutdown in that January period, reach out to them now, start having a look in advance as to where they fit and if there's anything that you need to do, and obviously get us involved if you need to as well. The earlier, the more chance we've got to do something about it. The other thing is you have the opposite side of that, and that is those that build up to a really busy Christmas period. I think the retail industry relies on a good December, January. Last year, the sales were higher, but profits were down considerably. So again, talking to your clients about are they ordering the right stock and the right amount of stock to get through? but will they be able to sell it at enough of a profit to make it worth buying? In some cases, I would almost prefer to see a store run out of stock because they didn't order enough, but they're able to sell it at a profit, than it is to have too much stock and then end up selling it at losses, which is what the false economy of the numbers that we see in these really big retail periods is that they'll tell you that the sales numbers are higher than ever, but no one ever talks about the profit numbers. And in the last 12 months, there's no doubt that the profit numbers are much closer to zero than anyone would like. So just a couple of things to warn everyone about. I think overall, what I really wanted to try and get across is that I don't think there is a person listening here today who doesn't have a client that isn't on the edge. If they are on the edge, there are opportunities now for them to help them get to the other side without falling over that ledge. Talk to them, get them involved with us, let us have a chat to them. And at worst, what's going to happen is that you're going to have a good plan B in place so that you can, in case things don't go the way that they hope, we know that we're set up ready to look after them in a more tragic situation. If it is already there, we might be able to show these people that rather than hanging on, that we can actually restart them in a way that will actually allow them to be profitable and allow them to keep a little bit of that money, and keep some of that profit for their futures. So please have a look at it. There's no doubt that these businesses are in trouble now. Unfortunately, what's happening with the online financing, with equity in homes and all those things, all of these businesses just keep trying to put good money after bad to solve the problem of today. And then when they do get to us, there's a lot less protection that we can provide than if they'd come to us earlier. So have a look at your client list, those that you're worried about. They're the ones that we should be talking to. My strategist team throughout Australia are ready to jump on the phone, come out and see you, sit down with your clients and work through what opportunities might be available to help them. That's pretty much all I wanted to say today. Nice, short, sharp, to the point, hopefully. If anyone's got any questions, please, you can type them out, or unmute yourself and I'm happy to discuss anything. No doubt Stella will put the poll up in a minute, for you to say nice or nasty things. And I'm hoping that there's someone that you're thinking of through this conversation, that you go, I really should have a chat to them and start looking at how we can protect and help them moving forward. So please jump onto that, jump into the poll, answer, and if there's any new topics that you would like me to cover, please put them in there. We will be back. Look out for it slightly different to our normal last Thursday of the month. We have got one coming up in the first week of December, and that will be our last one for the year. But just keep an eye out for the usual marketing material to let you know when that's coming up. Or I believe you can actually go straight onto the website and register for that now so you don't miss out. We'll go through in a little bit more detail some of the Christmas things that you need to be mindful of, and more importantly, the January and February issues that come into play. There's certainly that December, January, February can be a really horrific period for a lot of small businesses. Thank you all very much for attending again today. I really appreciate you taking the time out of your busy schedule to jump on and have a listen. Hopefully you got something out of that today. If you have any questions, feel free to jump on the phone and give us a call. Give me a call either directly or talk to your strategist that you're normally connected with. And we're more than happy to discuss any situation that you've got. So hopefully that gives you some insight into how to use insolvency as a tool rather than as a last resort. Thanks, everyone. Have a great day.